Hi viewers, you are watching Millennium Academy Accounting Hub.
Dear students, in this video, you will learn the solvency ratios in detail. Let's start to learn. Solvency ratios are a group of financial metrics that assess a company's ability to meet its long-term debt obligations. There are several different types of solvency ratios, but some of the most common include debt-to-equity ratio, interest coverage ratio, proprietary ratio. Debt-to-equity ratio is also known as debt-to-net worth ratio. This ratio measured the relationship between total debts and shareholders' equity. It is calculated as total debts divided by shareholders' equity. If a company has total liabilities of $10,000 and total shareholder equity of $5,000, then its debt-to-equity ratio is 2:1. This means that the company is using $2 of debt for every $1 of equity. The interest coverage ratio is a financial metric that measures a company's ability to cover its interest expense with its earnings before interest and taxes. This ratio is calculated by dividing earnings before interest and tax by fixed interest charges. From the following, calculate interest coverage ratio. First, we need to calculate interest expense and earning before interest and tax. In this question, the rate of interest on mortgage loan is 9% and 7.5% on debentures. The amount of interest on a mortgage loan is $900. And interest on debentures is also $900. The total amount of interest is $1,800. Now we calculate the amount of earning before interest and tax. Earning before interest and tax is the aggregate amount of net profit after tax, the amount of tax and interest expense. The amount of net profit after tax is $9,720. Tax is also $9,720 and calculated as $9,720 multiplied 50 divided by 50. The total interest expense is $1,800. Now we find the amount of earning before interest and tax is $21,240. Interest coverage ratio is earning before interest and tax is $21,240 divided by interest expense $1,800. The interest coverage ratio is 11.8 times. This means that net profit available for payment of interest are approximately 12 times. The proprietary ratio is also known as the equity ratio. It is a financial metric that measures the proportion of a company's assets that are financed by shareholder equity. It is calculated by dividing the total equity by the total assets. For example, if a company has total equity of $10,000 and total assets of $20,000, then its proprietary ratio is 0.50. This means that 50% of the company's assets are financed by shareholder equity.
If you like a video, then please subscribe to our channel and press bell icon for regular updates.